Welcome to the Meb Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Over the past 2 decades, we've seen our fair share of economic volatility. Between inflation, recession, and geopolitical upheaval risk, adjusting your portfolio can be a daunting task. One asset class that historically has served as a consistent hedge against this uncertainty is farmland. Investors, myself included, have been interested in farmland on account of its historically stable track record in the face of rapid economic change. Between 1997 and 2022, we've lost approximately 4.8 acres of cropland per minute to urbanization, while this same expanding population needs the food, fuel, and fiber farms produce. So why aren't more considering farmland? Access. Purchasing a farm costs millions of dollars, and working with local farmers takes time and agricultural expertise. AcreTrader provides investors passive access to farmland with investment minimums of only $15,000. Learn more about investing in farmland with AcreTrader. Investments in private placements are illiquid, speculative, and may result in the complete loss of capital. Securities offered through NCPS, member of FINRA SIPC. Welcome back, everybody. Today's episode is with fan favorite Joe Davis, Vanguard's global chief economist, global head of Vanguard's investment strategy group. His latest research on megatrends is covered in his new book, Coming Into View: How AI and Other Megatrends Will Shape Your Investments. Check out the show notes or search for episode 202 to go back and listen to Joe's first appearance on the show. Joe, welcome back.
It's great to be back. It's been a while, right?
It's been 5 years. You know, it's funny. I was like, I wanted to listen to a little bit of our old chat because it was great. It was almost 2 hours long. And I said, I'm looking in the archives. I'm like, when was this? A year ago? 2 years ago? This was like peak coronavirus, February 2020.
I do remember
crazy.
that. It's a little bit of the fog of war, but I do remember. But it seems like ages ago, right? That's the
Seems like ages.
Yeah.
Well, you know what the fun part, particularly about that conversation, y'all had just put out, you know, this paper and this kind of concept that, you know, we were immediately drawn to chat and you know, chatting about patents and all sorts of things. Can you walk us forward from the last 5 years on that paper?
What really started it was two things, Matt. Like, one was just AI as we know now, but if you go back 5 years, outside of the scientific community or the computer industry, perhaps not as well known as a concept, but I was reading increasingly about it. And my question was, how transformative could it be? At the same time, until the COVID shock, we were in a period of growth in the US, other developed markets, but it wasn't anything to write home about. And so a lot of economists were scratching their heads. So we had technology all around us, or some scientists saying, hey, this could be a big deal. But then the economist community is saying, hey, nothing's really changed. And I said, well, which answer is correct? So that started us down a path. Could we have actually tried to develop data, be data-driven, right? Not opinion. And to look at where scientific discovery could lead to technological change, which ultimately drives markets, earnings, and growth. And that led us down what we call the idea multiplier. Effectively, it is looking at all the ideas that are being generated that can be written down, patents, new medicines, articles by scholars. And we were looking at, is that accelerating in good ideas within those works? It was a huge data exercise, billions of data points. But that pointed to what I recall us discussing in 2020 was we were picking up signals back then that AI as a rubric, but more importantly, technology was going to accelerate 5 to 7 years out, because you're starting to pick up the ideas in the lab. They aren't in the economy yet, mainstream. And that took us a long time to get a handle on, but we're really proud of that. Now, you know, then COVID hits, we're dealing with a lot of inflation, but underneath the surface, I think we are today. I think it's fair to say, although the AI is not completely transforming the economy, that's a much more, I think, unorthodox discussion. But it was our insight. It was that framework 5 years ago that started pointing us in that direction.
Well, that's super cool because, like, as you mentioned, billions of data points, and you're sifting through. You're saying, I mean, this conversation, we're like, hey, things are happening underneath the surface, and we may not necessarily know exactly what, specifically, but it's kind of not predicting me, but it's kind of foretelling some really interesting developments. And here we are. I think I spent 3 hours this weekend on Sora AI videos and just having fun with AI and all these new technologies and the Sonu music and everything else. But it's pretty cool to look forward or look back, I guess, the last 5 years.
Yeah, what was cool is that we don't have to forecast the technology itself. It's based upon signals that are real, not made up, or I'm sort of making a story off of. It was and we're looking at high intensity fields, and going back to that point, we've tracked them since that time. And so if whether it's AI today, personal computer, and the internet 20 years ago, if it's going to be transformative, it's just not how much time AI is going to save us and how many cool little things I can do with it. It's going to be what are the new products and services that may use AI as a platform. And we talked about the idea multiplier, where I started identifying what those fields could be based upon the medical and scientific high energy, the ideas that were spreading at that time. And they're still in train today, things that we still haven't seen the new products yet. I wish I could tell you the new companies. I probably would be retired from Vanguard if I could. I'd be on some island somewhere. We can't, but it's areas such as healthcare, it's areas such as molecules. And so it doesn't mean that we are going to have a transform economy. It just means that the odds are elevated. And since that time, obviously, we've advanced our research even more to look at some of the headwinds that the world is facing. The globalization, we're at the risk of deglobalizing with tariffs, high debt levels, aging of society, rather than it just being a technology story. And that was then the basis for the book, because the diagnosis, much like the idea multiplier may have been eye-opening to us, the diagnosis of our over 2 years of research is really eye-opening and something that I did not see in my role, having been in the business for 20 years.
Perfect lead in. Well, let's hear it. The ideas are somewhat related. To talk to us a little bit about the book, the inspiration, and we will add it to the show note listeners. There's some other supporting papers and things Joe's put out that are great. So talk to us a little bit about the inspiration for the book.
We didn't set out to write a book, and just so all the listeners know, since I work at Vanguard, if there are any profits, if there will be donated to Vanguard's charitable, effort for kids in poverty. It's I only get one paycheck at Vanguard. It's from Vanguard, so but we didn't set out to write the book. It's just when I saw when we saw the diagnosis for what it means for the financial markets and the economy, I thought this would be an opportunity to bring these sort of topics. AI, how do I think about it? Aging of society, debt levels. You see the price of gold, right? Some are concerned about our debt. How can you make that accessible in a plain talk way, and then you don't have to be an economist and go really technical? So we spent over 2 years collecting the most novel data set in the world along all these dimensions, and I won't bore the audience with the technical details, but effectively make it as part of a data-driven framework, so we could talk about probabilities and magnitudes of what future outcomes could be for interest rates, for inflation rates, for growth levels, and for the stock market. Knowing there's a range of outcomes, right? We don't have a crystal ball, but we did it in a very novel way. So the data is new, and the framework and the approach we use I think, is pretty robust to account for changes as well as the push and pull of all these forces, along with the everyday factors we care about, such as what the Federal Reserve sets interest rates and commodity prices and so forth. But it's what the economic prognosis is, which is really eye-opening. So most economists on the planet expect a pretty stable 2% growth if you're in the US, 2% inflation, what I call in the book a status quo view over the next several years, next 3, 5, 7 years. It's what I would call the consensus forecast. The Federal Reserve has that view. Full disclosure to your listeners, I was part of that. I had that view too. Some of the negative forces will be balanced out with a little bit of AI, and we'll come back to 2% growth, 2% inflation, which is generally where we've been for the past 20 years. The framework and the push and pull of these various forces show that the probability of those forecasts being correct is less than 20%, which is a pretty bold risk assessment. And what emerges and what I did not see is the push, the positive effects of AI, which could really lift growth and innovation, versus should it not continue to advance, you go down a more somber path where our debt levels and weakening demographics push on interest rates up and growth down. And that's a financial market that's obviously not great for the stock market. And so you either get above expectations for growth in a material way, or you get more pessimistic. And so that's what I call the tug of war. It's very difficult to generate the sort of mainstream view, which is what the financial markets have generally been expecting. That's the eye-opening assessment. I mean, greater than 80% probability we're going to have a material change in the economic environment in the United States and many other markets in the next 3 to 5 years. Then the next question, we can talk more about what those scenarios look like, because it's effectively like two tails, a positive and a negative one. I wish it was only one, but the fact is right now it's unclear which one's going to win, although I provide odds based upon our data. And then with that, then there's the second and most important question probably from your listeners is, as an investor, how do I handle these scenarios and how do I think about that for my portfolio?
Well, let's dig in then. That's a great intro. You talk about some of these mega trends. I mean, you referenced AI and demographics. What are some of the others that are the key inputs? And then let's walk through kind of how to game plan this.
Like, in one sense, megatrends is it's a concept, it's a phrase, but the forces that we're trying to incorporate and evolve over time are not new to the field of to economics. They're not new to the financial markets. They've been around for centuries. One would be technology, but that's why we collected all the data for 150 years. We look at all three dimensions of technology: its ability to automate some of our work, including job loss, the ability to make us better workers. So technology is a complement. Think of a power tool for a construction worker. That's a complement, or a computer, say, for our jobs today, for some of our jobs. And then finally, the rare one, which is a general purpose technology, which unleashes as a platform new industries and new profit opportunities. All three can be disruptive, all three of those dimensions. And to my knowledge, we're the only firm or research body in the world that's actually doing this in real time across those three dimensions. And then we account for other forces, the debt levels and the deficits in the United States and other countries that affect bond markets, can have inflation pressures at times. That's a mega trend. Third is globalization. So the pace of trading across borders. We obviously have high tariffs and other aspects of globalization. So we account for those and its ebbs and flows over time. Demographics, obviously some say demographics is destiny. It's not, but it is a component of growth and it affects the labor force. So the demographics, the rate of change in the population, that includes immigration, which we have changes today, as well as the aging of society. And it matters in the United States in particular because we've tied some of our government spending programs, Social Security and Medicaid, Medicare, to some of the aging of society. And so those things are linked. And then we look at other things, geopolitical tensions, novel data sets going back over 100 years. We have tensions between the US and China today. And then finally, even things such as climate change. We look at earth temperature and water temperature. We try to incorporate all of them in what typically are ignored in I call Wall Street type of commentary on the economy. Everyone just looks at GDP on the next 3 months and prices, and everyone assumes it's just demand. And I think it is assumed that these forces move so slowly that, I'll worry about it on my grandkids, but they don't matter today. The truth is they matter a lot, and they can change, and how they change is affecting the economy and the stock market today. Way more than I think I appreciate, and I think the economist profession at large appreciates. It's half of the business cycle. So I believe this will change. This has changed how we forecast the economy and capital markets. I would be as bold as to say this could change how central banks forecast in their job, because these things are moving. And this is around risk management. Can we get some sense of where the risks are of these mega trends and how they interact with each other? How will they affect the economy and the financial markets? This is around risk assessment, because no one knows exactly how it will unfold, but we can certainly start talking about risk, which then gets into portfolios. and sort of diversification. So that's why we did it, and it's eye-opening economic prognosis. Funny thing is, I've been, with the book, I've been talking about this to a lot of audiences, and so we have this assessment. The most likely outcome is that what is a scenario that I call AI wins, which means over the next 5 years, we will have economic growth accelerate despite the aging of society and poor demographic profile in the United States, so much so that growth could be above 3%, closer to the level we had in the late 90s. And I'm not just saying it because I'm optimistic on AI. It's based upon what it'll do to the workforce, and it'll be disruptive. It'll probably be the biggest change in around 600 out of the 800 occupations we've looked at. It'll be the greatest change in how we spend our time in at least 40 years. It's going to be a big change, and it'll be disruptive, and there will be some job loss. But that's AI win.
Yeah, you have a great quote where you say over the last 130 years, Megatrends have driven about 60% of the change in per capita GDP growth and earnings yield.
Quarter to quarter. This is not a long-term thing. And I thought it was more of, hey, let's look out 5 years. It's affecting growth today. I mean, we have the job market that's kind of stalled. Okay, yeah, businesses have cut back a little bit, but so-called demand. We also have accelerating retirements. We've had a slowdown in immigration. That's the megatrends at work, and that's mattering, and that's what that will impact the financial markets and inflation as much as what I think is focused on all the time. And it happened a few years ago when we soft landed. It was not the Fed as much that drove that outcome as much as technology moving and demographic patterns moving at just the right time. And so that's starting to give us greater insights than we would have had in the past. It still leads you to try to assess risk in a probabilistic way because there's a lot of uncertainty, but it's opened our eyes, and we're leading to actually some pretty exciting investment opportunities as well as risk mitigation things that we can think about when we look out over the next 5 to 7 years. And it's certainly different than what I think many in the marketplace are currently talking about.
Ooh, that's a great lead, Jen. We'll get to that in a second. So how do you guys go about handicapping the outcomes and adjusting in real time? Because like you mentioned, like the AI sort of stuff is happening pretty quick. The demographics a little bit slower, of course, and geopolitical risk, who knows on any given day. But how do you guys handicap this?
There's proxies for, I mean, we're trying to control for that, not so much as forecast the last one, geopolitical tensions, but even things such as extreme as war. We're trying to get the past, because sometimes you got big shocks that you got to at least control for to give stability in the process in an unstable world. We're updating the data in real time. It's the deepest data set to our knowledge that exists. They don't have it in government. They don't have it in the academic communities, which is why I think our framework is really getting attention. I presented to tons of universities, central banks, to also get feedback. What are things potentially we miss? But we are updating it in real time. Since the book's publication, the probabilities have not changed materially. We have AI still accelerating from an investment standpoint. That would seem to push up the odds of AI win scenario. It's still roughly 60%. Why is that? Well, at the same time, we've had some of our deficit projections, with some of the recent fiscal measures also worsen at the margin. And so that would push the AI disappoints and the deficits dominate scenario, the more negative one, has also kind of gone up a little bit. So it's been pushed, but that won't persist indefinitely. So we are updating these in real time. And then of course, we also have to compare that to where the market is already starting to entertain. I can tell you this though, the thing that I think has many perplexed, but in our framework is not perplexing, is the rise today, like in the past 6 or 12 months, the rise in tandem of the price of gold and the S&P 500. Particularly technology stocks. Usually those things go in opposite directions. If we think the world's going to end, the price of gold goes up and stocks, really fall. And when everyone's excited and optimistic, gold doesn't do anything, but stocks do very well. The fact that they're both going up is actually consistent, at least with our projections, that you have non-consensus outcomes emerging. Both a pessimistic one, which is a little bit closer to what those that are buying gold would be consistent with their thesis, as well as the more optimistic one in terms of AI being potentially transformative, right? And the stock market is very excited about that. So the prices today, I'm asked a lot, like, how do you square that circle? And it's actually, to the best of my knowledge, our framework is the only framework that actually explains the rise of both, because we are saying there is high odds that we are not getting consensus outcomes, and it's going to push one way or the other. And I wish I could just tell this audience it is only skewed one way or the other, because it's a very easy narrative, but it's too early in both AI's pace, and the deficits would have to materially worsen. And AI has to get materially better. So everyone who's using ChatGPT, it better get way better than it is right now to get the lift we need to overcome some of the headwinds the world faces. And our model and our projections are simulating what those futures could be. And that's where those probabilities are coming from. But by 5 years, we'll know it for sure. And it's unlikely going to be the forecast that most of my profession, I think, is hanging their hat on. And so it's about trying to prepare. But I think there's a signal. The financial markets, I think, are starting to entertain non-consensus outcomes. So I think we're on to something here. The question now is, what do I do about that, given where the stock market and the gold prices are today?
You mentioned you've had conversations with central banks and institutions and various groups as you kind of present this thesis. What's the traditional response? Like, are there areas that people get squeamish about? Are there areas you get a lot of kickback about?
So I get two reactions to this forecast depending upon where I present. So I'm not going to name drop because I just want to mention the institutions, but let's call it when you go to, well, I won't mention companies. There's been a lot, but when I go to Silicon Valley and I show, listen, roughly 60% odds AI is going to be transformational and we're going to get this growth, but there's going to be some disruption here, and 30% in the downside, they say 60%. It's 100%. They are 100% convinced that AI is going to be transformational. The next general purpose technology is going to unleash growth.
They better. Their portfolios are not going to return anything. It's like 70% of all deals.
Yeah, they think I'm underestimating the impact, even though our economic projections that are, when I'm talking about not narratives, when we actually put data and pen to paper, to my knowledge, Vanguard has the most optimistic economic forecast of the asset management industry. We're the only ones that have this framework, but I don't see anyone else having these projections. And we're not making it up, Matt. Right? We're trying to use data to bring. It's not like I woke up one day and I got optimistic. We're trying to hold ourselves accountable to an uncertain future. Of course, when I go to other institutions, including some of the best universities in the world, some of whom are skeptical on AI, there's some leading labor economists that are pretty skeptical. AI is not going to give you as much lift as people think. Some of them are on the East Coast. You can think about large, prominent academic institutions on the East Coast. And when I go there, they say, how is your deficits dominate scenario not 100%? Right? Because AI is too hyped. It's not going to get the lift that we think. And so I get pushed at the tails, actually, even though nearly 100% of economists don't have either as their forecast. Nearly every economist, and again, I was in this camp as recently as 3 years ago. Oh, we're going to get 2% growth, 2% inflation, plus or minus. It's consensus. It's neither of those forecasts. So it's a little bit of a bizarro. You'll get the push on either extremes, and yet the economist community, the so-called experts, don't see any change at all. So I've been trying to take the other side of saying this is why AI it's not 100% odds it'll be transformational. And then for the deficits dominate, I say, listen, not everyone run to the hills and buy gold. You have to think about what that world looks like. And it's not necessarily the world that you're worrying about where you're putting gold in your portfolio, but it is disappointing from an economic perspective. So I have those conversations with all those audience. It really depends upon where the audience is and where their own assumptions are, or their beliefs or their own analysis. So it's been pretty eye-opening. I'm just proud that Vanguard's trying to help this discussion. Let's get out of the narrative business. I wanted to personally get out of the narrative business. So, I think it's going to be X. Like, well, where's the science? Where's some of the numbers? Because if we can start talking about probabilities and magnitudes of outcomes, now we can start talking about risk management, and now we can start talking about asset allocation from a risk management perspective. It's what Jack Bogle would have done.
People love narratives, though. Man, like it's narratives. They get their stories. I'll tell you a funny one real quick, talking about gold. Gold has just been on this crazy tear, and we had a tweet, back when gold crossed over 3,000. I said, gold is doing great, but not a lot of people talking about it just yet. Sentiment, and just like squishy sentiment from my perspective. But we had done when you started to hear in the media a few years ago that Costco is selling gold bars, and I said, "There's no way." And then there's they're selling like 50 million a month or something. I said, "No way." And so I went online. I found out, sure enough, Costco was selling gold bars, and they were sold out. And I found out Walmart was also selling gold bars, and so I went through the process. I'm like, I'm going to do my security analysis, due diligence. I'm going to buy a gold bar. So I buy one, and it sure enough shows up at home. And then I was like, oh, what am I going to do with this now? Like, now I got to buy a safe to put this in, or a box at the bank. And so as a joke, and my son was young, I I don't think I told my wife. I put it under the tree to me from Santa, and I opened it up, and sure enough, I got a gold bar from Santa. And like a year or two later, we were hanging out with some friends and other kids, and my son was like, "Dad, you remember when Santa gave you a gold bar?" And I was like, "Ah, shut up, son!" Like quiet. Like it makes it sound like, "Hey, we're just giving out gold bars at home." And but it was funny because I was trying to go through the experience. I'm still not sure what to do with it. We still have it, but gold's doubled since then. So
Doubles.
maybe
Double.
maybe he'll go to college someday. But it seems like it's now. You're hearing it, right? Like the sentiment you're starting to hear. I mean, you kind of have to, and something's up 50-60% in a year.
Well, and then there's incredible momentum, and now for both AI stocks as well as gold. I'm just saying there's hype in both AI stocks and gold. I don't know exactly where the fair value is. I can tell both of them are starting to approach beyond 100% probabilities in our framework. Gold on the downside, AI on the upside. So it's pricing in beyond our risk assessment. And at least we've done the math and saying this is what a likely outcome could be. It's because that's one of the reasons that's the value of this framework. Now I can compare it to the actual market, because the market has its own discounting mechanism, right? It's trying to ascertain a lot of things. You may not even care about Joe Davis, your little fancy framework. That's millions and billions of investors saying they're putting their own capital to work. And so there's clearly some hype, but I think there's a signal in this that there's change coming, but it's not like a doom and gloom thing. I'm not doing it to be alarmist. Here's the other thing. I wasn't looking for this outcome. I was happy by 2% growth, 2% inflation. I fill out the Fed surveys. I'm on these surveys as my role as chief economist. I'm thinking it's a reasonable outlook. Oh yeah, every 6 months we'll be a little bit up, we'll be a little bit down, but Fed will do little things here and there, but makes sense.
So tell us, let's hear the not just the diagnosis, but the prescription. Like how should the allocators out there start to think about these?
Here's the thing. This was so when we did this, we also collected all this data on market history and investment cycles, right? Because a lot does rest on technology, and that's not new. It's always been the case, right? If AI is transformational, we're going to have higher growth. We'll have some disruption. You're going to have some job loss, but it's as if we had no demographic headwinds. It doesn't mean we solve our debt issue, by the way. It just means we kick the can like the late 90s. And of course, if it peters out, you can imagine what that will lead to disappointment in the equity market, and we'll get some pressure on interest rates. We don't get high inflation because the Federal Reserve fights it, but the gold's thinking about that world a little bit. It's where the dollar and our prospects are a little bit Japanese-like. So, what is the prognostication? So, let's talk about the pessimistic one first. Everyone thinks it's gold then, right? We're going to be debased as a currency. Growth hasn't gone anywhere. Certainly the stock market underperforms. In fact, if we go down the deficit dominate scenario, stocks get bond-like returns. So it's a lost decade for stocks, given where we are on multiples on average. It doesn't mean you should run for the hills, but there's definitely downside risk. Interest rates have greater pressure on them. Ironically, though, the asset that you'd want to hold, you want to be diversified, but the greatest diversification is actually in the fixed income side, even though you do get more volatility in bonds. And that's because of the downdraft in equities. But you have the Federal Reserve that's keeping rates well above the rate of inflation. In part, they have to, because deficits continue to rise and there's some inflation there. And that's what the gold camp misses. The gold camp assumes that the Federal Reserve does nothing. They recede from the battlefield. We have high deficits, keep going up. We get a currency debasement and we get this inflation like the 70s. That's possible. We show about a 5% probability of that happening. It has happened in the past in some countries. My point being is gold, that's the Achilles heel of the gold trade. Even if you're pessimistic on AIs, you're giving no role for the Fed. And most likely than not, the Fed is holding the line on some of this, and you get that high income carry of short and intermediate duration fixed income. There's more volatility, but the greatest volatility is in the equity market. So that's actually the strategy is if you have a world where fiscal pressures have manifested and we haven't had the AI boom, you actually want to overweight fixed income. So higher debt world, you actually want to overweight fixed income. So that's the contrarian and it may seem counterintuitive strategy, but it's not gold unless you dissolve the Fed and they completely ignore their inflation mandate, which is always a possibility, but you can see why the framework doesn't assign a really high odds to it. So I could see a little bit of gold in that world if you believe that world's going to manifest. It's more of a tail risk. It's effectively a risk against the Fed not doing what they're supposed to do for a long period of time. But let's talk about now on the optimistic sounds even more contrarian. If you think AI is going to be transformative, right? If you believe the most likely scenario in our framework, higher growth, that will translate effectively the market could still correct for sure, high odds of it correcting, but point to point, you can grow into the multiples we have today. The most compelling investment strategy in the investment cycle in that world, now you have to give it 5 or 7 years, is actually the more bullish you are on AI, the more you underweight technology in your equity portfolio.
Oh, that's a spicy take. Let's hear it.
And the reason I didn't see this coming necessarily, because it sounds like, hey, if we're going to have a tech boom, invest in the tech companies. The more we did digging, and we looked at, again, 150 years, different technologies emerged, electricity, the automobile, transistor, computer, internet. Yeah. But, you don't have 1,000 of these examples, but you got enough. What becomes very readily apparent, although the timing always varies a little bit, is that there's 2 phases to this technological transformation, assuming AI is the next general purpose technology, which again, I'm saying there's a 60% odds that's going to happen from what we know today. The first phase is, almost without exception, is the production of that technology. People are buying it. Businesses are unleashing it. If it's the personal computer and the internet, it's the late 90s. You can think of the internet companies, it's the personal software and computers. I talk about this all in the book. And of course, those stocks, I'll call it tech sector, but electricity, utility companies were the tech sector in the 1910s. Yeah, automobile manufacturers were the tech companies in some of the 20s and 30s, but let's call it tech sector. They drastically outperform in the first half. And there's no surprise, perhaps, that some technology stocks are outperforming today. What I was surprised to find is that in the second half of the cycle, the non-tech companies outperform. And there's 2 reasons for that. The first one is, listen, this technology is transformational. It transforms the economy, which means it now starts to raise the efficiency, productivity, new earnings growth, or business models for companies that are outside of the tech field. Because again, by definition, it's become transformational. If you want to look at an example, in the 1920s, electricity unleashes automobile profitability because it's powering the assembly line, right? It's a beneficiary of it. If it's AI, tell me what it's going to make a hospital more productive, right? Or asset manager, how is it making banks more efficient or better insights? I don't know how, but if it's transformational, it better do that, or it's not a general purpose technology to begin with. If it doesn't do that, then it's like social media. We all use it, but that hasn't really done anything for growth. And so that's the first reason why value outperforms growth in a technological change environment. The second reason is because of the massive amount of new entrants that go in the technology field, which generally reduce the cost of the technology, make it more likely to expand and be transformative, but it reduces the ROI of some of the incumbents. Some great companies still emerge from it, but it's the hundreds, if not thousands, of startups in the internet space and personal computer space. There's high failure rates. And so as a basket of securities, that new capital reduces the ROI of the incumbents after the initial phase really kind of starts to peter out. And I don't have to call it a bubble or not. I'm not calling it a bubble. I'm just saying that's what starts to happen. And if say, well, is that going to happen in AI? I think the odds are high at some point. And I'll leave you with data from Stanford University's AI lab. If you look on their website, you'll find that in the past 4 years, over 5,000 companies in the United States, AI companies have been funded. 5,000. That's more than all the publicly traded US companies. So I'm not saying that AI is a bubble. What I'm saying, though, is there's rationale to expect at some point, even if you're bullish on AI, to start thinking about what are the next waves of profitability. And that would start to push you outside of the Mag 7 generally. It would push you outside of the US at the margin and outside of tech stocks. And it's not because I'm pessimistic on AI. It's actually quite the opposite. It's that's how technology cycles tend to work from the investment phase. Timing this is very difficult. I won't be able to do it. It's roughly 5 or 6 years on the up, and then there's a 5 or 6 years on the spreading. And I'm talking about the spreading in the second half. Our framework captures those dynamics, but you have to give it some time. I would never be able to time this thing, right? And if I was an active manager, that'd be tough to say. I am not saying short AI companies. If it's 97, you got 2 more years of amazing outperformance. You probably lose your job. But if you're a long-term capital, if I'm at home or if I'm your listener, I've done well. Let's say I've been in the S&P, right? I've been in the S&P. I'm doing well. I'm trying to diversify my bets just a little bit. I'm a long-term investor. Or I've been in the tech, and tech's really going up a lot. I'd say if you have new capital to deploy, looking to rebalance a little bit, start to balance those risks and start to thinking about maybe it's outside the S&P or as outside of the IT indices, and think a little bit at the margin, maybe outside the US. This has nothing to do with relative valuations. I'm talking about how technology cycles work. And you don't have to make a call whether or not AI is a bubble or not. I think that's more of I think you and I could debate that for 9 hours and not lead anywhere. I'm trying to offer what are some of the next half of the chessboard sort of investment that you can, and you don't have to rush this. You can start deploying new capital without selling your existing holdings. It's more of a risk mitigation perspective that's consistent with AI being transformational. That's the cool thing. Now, again, what emerges from this framework I didn't see coming up is that on the pessimistic side, you would want to underweight technology because AI's proved to be a dud, right? Deficits dominate. S&P 500 is going to underperform for 5 years. AI wins, you diversify away from the tech sector. So I'm not picking on tech companies. What I'm saying is in either scenario, you underweight technology stocks. And that's 85% probability. So that's a pretty eye-opening assessment. Other assets, like anything, perform well in one state or the other. Gold may be entertained a little bit of a bid on the downside, but not on the up. Conversely, some other things, but fixed income does pretty well in both because you have high interest rates, but not an alarming level, either because of high growth or from high fiscal pressures in the downside. And then you have actually it's where the headlines aren't in the stock market. It's outside of some of the Mag 7, which is where you tend to have elevated odds going forward rather than they have in the past. But this has nothing to do with mean reversion. This has to do where we are today and where technology could go versus these other competing forces.
And, we can kind of talk a little bit about the capital markets model too, which is not too dissimilar, right? It's also saying, hey, like the US equities, maybe a little lower return and things outside the US and value maybe a little bit better. Is that a decent overlap?
So over this past year, my team and I, we have it's a large, Vanguard's very, we have one of the largest research teams in the asset management industry, just so people know. So we have a great team. I have a great team to work with. We have over 100 crew members, 100 employees. We're large. And given that depth of expertise, we haven't been spending this past years. We've incorporated some more of the AI assessment, which is positive actually on the equity market. That may raise our equity market projections a little bit, particularly in the near term, because the momentum is powerful. We can't time this, but you got to acknowledge the earnings positive and the fact that we're unlikely to have a recession in the next 6, 12 months. It's possible, but it's just not high odds. But yes, that's consistent with our capital market projections. And I'm given the economic intuition why, not just because something's done well, hence we're going to say it's not going to do well. That's called what's called mean reversion. That's a pretty dangerous sort of like logic or framework, because the mean that we're going to go to in the future can change. And our framework is saying that future level is going to change. But yes, we are disclosing these sort of assessments at various horizons. The near-term market has got some pretty good momentum to it, but I think it's starting to entertain this odds. I think this is around, if we're going to be in the next several years where there's great opportunity, there's also risk that I think we can start thinking about without divesting from the market. And I'm not talking about that, but I'm talking about as our smart ways that we can kind of give our portfolios a little bit of resilience, knowing that we've benefited over the past several years. And that's the work we're doing right now. And that's what some of the book talks about. I would not have been doing my job if I tell the reader, hey, we're going to have these two different non-consensus outcomes. Good luck to you. Like, well, what's the value of that? Let's now start thinking about asset allocation. These are things to consider for your listeners. It's their decision to make, but and that's was the most eye-opening to me. The most gratifying is some of these non-momentum but very intuitive sort of investment things to think about over the next 5 years, whether it's value stocks or fixed income. They're not getting the attention in the headlines, but it's actually very consistent with past investment cycles.
It's interesting is that we talk to a lot of investors and financial advisors and sit down and they're clearly consistently US focused, more than the market cap weight, of course. And I always kind of giggle a little bit when I read the Vanguard capital markets model, because there's two. In general, I feel like advisors are receptive but wary about foreign stocks. They're like, well, look, I have some, but usually they're underweight and usually they're grumpy about it. And second is because they've underperformed S&P for so long. But the one area that y'all talk about as part of a portfolio that I almost never see any financial advisors have is ex-US bonds, right? Sovereigns, foreign sovereigns, and emerging market sovereigns credit. And we use them in all of our allocation funds, but the average advisor, it rounds to zero, despite being one of the largest parts of the global market portfolio. What do you think the resistance is, and should they change that?
Well, I think it's worthy consideration of how we define diversification, right? And I know you have a process, right? And you're thinking about it. One is the standard, hey, I just want to reduce average volatility at the margin. Standard deviation, I want to take from, 8 to like 7 or 6 or 7.5. There you look at that's where international bonds on a hedge basis will do it. You know why? You get a little bit less bumpy ride. Not game changing, but certainly it's valuable because you have different yield curve exposures. The German yield curve is a little bit different. These are developed markets, Japanese yield. And on a hedge basis, you get similar yields, but they're not all in the same monetary policy cycle. So that's a little diversification, right? So you lower the vol at the margin. And that's done that on average. Now, that's one way to define risk, is just month-to-month volatility in my portfolio. There's another form of risk, which I would say is state of the world in some future state, which is like wealth. Like, I want to avoid bad outcomes more so than good outcomes. And that's not always consistent with just month-to-month volatility. That's like, hey, a big stage. I'm not saying international fixed income can't help there, but that's where you see some flocking to gold. And I would say if you're going to do that, there's other things you could think about, both on an unhedged currency basis, both in the equity market, as well as if you're going to do fixed income. That's more of tail insurance, because you don't want to hedge currency exposure back to the very currency that could have a fiscal crisis. So you'd want to unhedge it. But that's going to throw, why we don't recommend that as a general par for a course is month to month volatility of unhedged fixed income. I'm adding currency risk to a fairly conservative asset class. It's throwing off stock like volatility. I mean, more so than high yield. So it throws off that framework. And that's why we don't talk about it. And I think most investors have at least a little bit international unhedged equity exposure. So their overall portfolio has some unhedging. They're not hedging everything back to the US dollar. And so that can get you most of the way there. Should we have some pressure on our currency, which is probably not the main reason why they're overseeing investing, but nevertheless is so there's two type of risk. One is the sort of the US dollar as a reserve currency. That's more, I'll put that in future state of the world a little bit. Some maybe tail. Other people think it's not a tail. It's more significant. Either way, that's how you could think about it. Then there's just month to month volatility, standard mean variance. Let's reduce vol a little bit. And that's where we go first. And that's international bonds. And that's why it's hedged. And many people don't do it, but we do it in our target date funds. My team and I, we sit on those committees and still believe in that. Again, the biggest flight to quality is just having fixed income, period, given the equity risk, right? That bar one. And so I understand advisors, yeah, their primary focus is on US dollar, corporate bonds, munis, high quality munis or treasuries. I'm not saying that, that's good. I'm just saying at the margin, let's diversify our currency exposure. That was always one of the rationales for us. And one source of debt financing. And we're not being alarmist. We're not making some huge statement on the future of the United States. It shows up in historical record in other countries. And so some people are starting to talk a little bit about that with the price of gold, but that was always in our mind of saying, listen, just diversify the US Treasury exposure a little bit. And we're not being alarmist, just a little bit, because if not, you really have a focused fixed income allocation.
For some reason, and I think part of it may have been, at least in this last kind of regime generation, investors got caught up in particularly the sovereigns being negative yielding, and like that, I think probably poisoned the well for quite some time.
But that's the funny thing is they don't get that yield. They get, as you know, they get the hedge yield, and given the currency rates, like the Japanese yen, as a Japanese bond market, they were at the zero bound, yet their treasuries were throwing off 3 or 4% coupons for the U.S. investor. Now, again, it's not muni tax exempt, where I get an after-tax yield right now 7%. Right, so it depends on the environment where we're going, but a little bit from a diversification, you don't get their yield in Japan. You get what's hedged back to you as a U.S. investor, and the currency markets are trying to adjust for their zero bound and do the math for us. Not perfectly, they're doing that.
You talked to a lot of financial advisors about AI impacting the profession. I think I saw the AIs can pass CFA level 3 now. You can code, and you're speaking to maybe the younger people too. How should we start to think about the profession from, whether it's our seat as managers, whether it's the advisors? Is there anything they should be noodling on as they try to think about the next 10 years?
Yeah, and I can't believe it's been almost 10 years now since we started down this path of looking at what the future of work could be with AI. I was trying to come up the curve 10 years ago. What is this AI? I'm not a computer scientist. I can't believe it's been 10 years. We've done a lot of work on occupations. We're not educators, but because we care about the macro impact. How big is this going to be? And I talk about that in some of the book again. And I tell you though, so I have college-age kids entering the workforce. I'm a manager here at Vanguard, so I'm also an employee. So I'm not ready to retire yet. So what should I be doing? What should my team be doing? I would say what I'm saying to everyone for just knowing that I have that line of sight on AI at the macro and labor market. My counsel for everyone would be use it as much as humanly possible in your current job. And the reason for that is twofold. One is there's just a learning, much like we had the personal computer. So I'm dating myself. I remember the mid-90s coming into work and what's this Microsoft Excel tab? And do I have to use this thing? And what are macros and links to other spreadsheets? And I mean, today I take it for granted, but it was new back then, at least for me, and I had a technical background. I would say use it and get your awareness of what can be done with the technology and start trying to feather that in where you can to save time, get a little bit more efficient. But I'm saying that there's a learning process to that too, because in some occupations, we do diagnose some that are going to have, I wouldn't say complete automation and job loss, but you're gonna see some significant impacts, particularly when you look out 6 or 7 years. Computer programmers is one of them. Some financial service professions are them. Economists have a high automation rate by some of our analytics scores. So we've done this across every occupation. And I would say to everyone is embrace it. You will learn, you will become more productive than your competitor, you know, person out there in the labor force. So you should do, if you get more productive, you deserve a raise. So you should just be doing it just to do it, to make more money. And if you're in one of those professions where you start to realize after a year or two, you know what? I'm starting to see the writing on the wall. I see where AI could be going. I think it can start doing 50, 60, 70% of my job. Let's just say that I'm sitting in a profession that starts to look that way. Well, if you're using it a lot, you will start to see the writing on the wall, and that will give you some time. Will it have to be an adjustment? Yes, but it'll give you some time for job transitions, which ultimately happen, whether they're voluntary or not, when you go through these periods of change. So that's why I would be telling everyone to use it in their own self-interest. One is to just make more money and be more productive. But and then if you do see, oh wow, I goodness, or you can sell it for your colleague or your children. Hey, I won't go in this profession, but you're going to have to use it, and don't be intimidated by it. If it's as transformational as it could be, we shouldn't need data science degrees to use this technology. The funny thing is, the electricity, the first 20 years after Thomas Edison invented electricity, so late 1880s, first 20 years, it's kind of in a few streets. It's in New York City. The only 1,000 people who in the United States who knew how to use electricity were called electrical engineers. You actually needed electrical engineering degree to operate it, and the voltage, and it was very dangerous. Obviously, you and I can use electricity today. I don't need any degree. Just plug it in a wall. And I use that simple analogy to say that's the future. If it's going to be as transformational as I think it is, I will not need a data science degree, but I'm going to be able to need to know what it can do, like the personal computer and the software we use, to be able to do my job better and be able to get the insights I need or whatever value I need to create for my client or for my company. And so the more quickly we can get a handle on this, or as a worker, you can get a handle on this, the better it is for you. And for those that are worried about job loss, you'll be able to start to diagnose it yourself, and you'll have picked up new techniques that you may be able to pour it into another thing. So that's the advice I'm giving people or giving my family and friends.
Yeah, it's simply just, being an early adopter on the usage, I
Yeah.
think is what's fun, no matter what, y'all. You can have some fun. We coded up a Meb AI that was based on all my writings, and we'll put a link in the show notes, listeners, and we'll have people that'll email us conversations they have with AI me. And it's like 80 or 90% what I would say. I mean, they'll even ask it portfolio questions.
Oh yeah.
Say, here's my portfolio. What's missing? What would you say? And the one takeaway is, because I think we submitted Twitter logs too. So the responses are a little cheeky, like they're a little more casual, I think,
Thank-
than
Yeah.
I'd like to
Yeah.
think so. They're a
Yeah.
little, but it's actually pretty solid. I did another one where we did a custom GPT on, kind of a Mount Rushmore of like 6 different thinkers. And I was like, ask questions. And I was like, all right, well, how would Bogle, Munger, all these people respond to this idea? It's pretty good, to be honest.
That's actually pretty interesting. It's also change. I don't like change in my daily life. I don't like change in my routine, and it's change. There can be a little intimidation. But I say, listen, I'm up the curve on some of these tools. I'm not like I had vernacular knowledge of all this stuff 7 years ago, and but we even embrace our research team. We're pretty technical, advanced degrees all around the world. We're even embracing all the AI for stuff that we had other statistical backgrounds. Funny, we're using actually AI models to predict the future of AI, which in of itself is kind of crazy. But it's all around just getting better risk. It's going to be compliments to some people. It's going to be a substitute for what we all want to. We all want to save a little bit of time. The funny thing is that when I get it from like from a lot of people say, "Oh, automation's bad." I said, "Not necessarily." I said, "We actually The lack of automation in the U.S. economy today, in the world economy, is subtracting the most from growth in over 150 years. That's why we have to throw a lot of people at the service sector. It's 80% of the jobs. People are working hard, but we have not had a major new, really, sort of new technology since the personal computer with the internet. We're going almost 30 years now since that big boom. Bob Gordon talked about this Northwestern. That's why he said all the great ideas are all over. Our framework says, be careful. That's not necessarily correct, but with that territory comes change, and not everyone's going to win. Like free trade, not everyone wins, and so I try to at least identify and give the audience, here's some professions where you're going to see some job loss and disruption, but the converse is stagnation. If you don't want change, we can stagnate, and that means everyone's average standard of living and wages aren't going up at all. Or we can have disruption, growth on average, but you're going to have winners and losers. It's one. That's where our two futures are. I'll pick the disruption with some winners, but not all boats are lifted with the tide.
As we wind down, Joe, you're always working on something interesting, and hopefully we won't wait till 2030 to have you back on. But, as you guys are getting your crazy coworkers in the lab and brainstorming ideas, is there anything as we look out the horizon of 2026 that you guys are thinking about working on? I know we talked about a lot today.
My team is, we're on a lot of disciplines. So we're thinking about stock and bond portfolios will always be core. We've also thought about always low cost investing. We think about, are there certain active strategies that can add value at the margin? This is Vanguard. We've had a long history of active management too. Retirement income. Not necessarily there's a panacea, but many investors are saving for retirement, but some may be drawing down. They may be retired. What's the most efficient way to do that, right? There's some good standard ideas. We're thinking about that too. And so my team's heavily involved in those areas. And then on this AI front, it's saying, okay, what else can we be looking at? We may be missing, but I'm proud of the fact that I think we've put at least our finger somewhat on the pulse of what's going to dominate the conversation. I think it's already happened this year, of this tug of war between deficits on one side and AI on the other. And the course this year, everything from Liberation Day to the AI headlines today, I think we put our finger on it. And I promise to you and your listeners, we will continue to disclose what those probabilities are as they evolve. No one knows what truth is. I'm not claiming we have truth. I'm saying is that we're trying to give our best shot. And then investors can use that in their own calculus, right, to do what they see fit. So we'll continue to do that.
Beautiful. Well, as you're writing, Joe, what's the best place for the listener to find what you're up to, what you're writing about, what you're thinking about?
Well, hey, Vanguard, we teamed up with parts of the Wall Street Journal. We have a new podcast. We're not on episode 200 and something. We're just
600, man. You were number 200. We're now up to 6.
We have only a few, but it's called Better Vantage by Vanguard. But we're trying to bring thought leaders. We start off with some Vanguard, obviously, but we'll have outside guests as well. And I'm trying to decloak the nomenclature, and not waste people's time. Like in 10 minutes, can I get to the bottom line of this? But we'll see how we do. It's new.
Very cool.
But you can point that it's right out of the gate. It's on Spotify and Apple, all that good stuff.
Well, listeners, check out the very great book coming into view. We got pick up a copy on Amazon or your local bookstore. Joe, thanks so much for joining us today.
Thanks for having me.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.